Welcome to Wealthion. I'm Wealthion founder Adam Taggart. I'm actually on the road this week, but I wanted you all to still have great content to watch while I was away. So I'm making available here the presentation given by Wall Street legend James Grant that aired at the Wealthion online conference in late January. Now, that was before all of the crazy volatility that's happened since, given the war in the Ukraine has broken out. But it's very interesting to see how Jim's insights are just as relevant today, if not even more so, given how things are unfolding in the world. Well, the macro theme here at the start of 2022 is rising interest rates. What impact will that have on the economy and the financial markets? Well, when trying to understand where the puck is headed, it's best to seek the counsel of the top expert in hockey, which is why I'm delighted to welcome James Grant, esteemed publisher of Grant's Interest Rate Observer. Jim, thanks so much for speaking with us today.
You're welcome, Adam. I can't skate.
I know you're more of a baseball guy, but still,
Yes.
I wanted to stay in the sports world. Well, look, as I said, interest rates are on the move. In the past 6 months, the U.S. 10-year Treasury yield has increased from about 1.2% to around 1.86% or so. It's a 55% increase. And of course, the Federal Reserve has, announced its intention to raise the federal funds rate at least 3 times this year. So if we could just start sort of from a high level, what is pressuring rates higher here?
I think the expectation of less accommodative monetary policy is number one. Also, there's the obvious consideration of a rate of inflation now measured at 7% year over year in the latest tally. So, the value of the dollars in which one's savings or one's bonds are denominated, that is dwindling. And customarily, during times of inflation, rates of interest rise, especially for long-dated securities. And what is even perhaps more striking than the upward move so far this year is how low are rates even after that considerable percentage increase. The rate of inflation, we can't call it 7%. The federal funds rate is sensibly zero. Not once during the 15 or 16-year inflation of 1965 to the, say, 1981, not once during that 15 or 16-year period did a real rate of interest, we're now talking about the federal funds rate, get anything like minus 7 percentage points. Never. So we are living through a time of truly unusual, if not unique, monetary events. Which is, I guess, a warning not to dogmatize about the future, because this is something new and special.
Okay, something new and special. We're sort of entering Terra Incognita, which is really significant coming out of your mouth because
we've been in Terra Incognita for many years. The whole institution of nominal interest rates valued at less than zero. That's a new thing. That's a 4,000-year new thing, according to the tome we all have by our bedsides, Sydney Homeless History of Interest Rates. So interest rates these days are as low as they've ever been. That goes back 4,000 years. The Federal Reserve is breaking new ground, or has been breaking new ground in its rate of creation of new credit. And it's a wild time in money.
It's a wild time in money. All right, it's a great way to summarize it. I'm just going to put up a quick chart here that sort of illustrates a lot of what you've been talking about, which shows what's happened with both nominal rates and real rates over the past couple of years. We do see, recently they are, despite being at these 1,000-year lows, they are beginning to creep back up a little bit for the reasons I mentioned just a few minutes ago. So we now have this tug of war between rates beginning to rise again, from very low nadir, and also inflation, right? And I want to talk to you about inflation in just a moment, but we're beginning to see rates creep up. Like I said, the Fed is saying, hey, we're super serious about sending them even higher. how, looking out ahead, say the next year or two, where do you think interest rates are headed, both nominal and real? Higher, lower? They're going to sort of plateau and stay the same? What do you think?
I think higher. I say this with due humility, the future being a closed book. But I think we're looking at the collision between two kinds of inflation. One, inflation on Main Street, which is getting all the press now. And the second is the inflation that has been roaring for many years on Wall Street. So in financial assets, we're looking at valuations that have rarely been exceeded, looking at all manner of aberrant prices attached to the most curious and strange kind of assets, from second order cryptos to fancy NFT, non-fungible tokens. Huge emissions of debt to finance private equity transactions, all these things sustained by the better part of a dozen years worth of interest rates, certainly low and arguably suppressed. So interest rates, real, substantial, manly, farm to table, old fashioned, interest rates are a kind of a kryptonite against such things as profitless tech companies, all these venture capital promotions, all manner of these oddments that you find quoted in the Wall Street Journal these days. And the specter, never mind the presence of substantially positive, from the point of view of inflation, interest rates, is having its predictable and customary and brutalizing effect on a wide range of assets that had no business being as high as they were, and would not have been had the Federal Reserve not conducted the most open-handed and aggressively accommodative policies in its 100-odd year history.
All right. Well, I want to really dig into that, and maybe we should do that right now. Like I said, I still want to get to inflation, but you basically said that higher interest rates are kryptonite for all the highly speculative assets that have been thriving so well in the past decade or so of rock bottom interest rates and super cheap liquidity. I infer from your comments there that you would then think some sort of reckoning is coming. And don't let me put words in your mouth, but do you expect some sort of corrective process to occur here as rates continue to rise, where the hot money that has been flowing with such fervor into those speculative assets that you just listed off, begins to flow out?
I do, yes. It's like two weather fronts colliding, although these are both warm fronts, so I'm not sure what the meteorology is. But I don't
probably a Sharknado.
Yeah. I'm not sure that. In fact, I am reasonably sure that this great speculative torrent is not really going to continue in the face of the pressure on the liquidity that has sustained it for so many years. So one question before the House is whether the Fed will persist in the face of a prospective pullback, a broad pullback in financial assets. It didn't take much pressure in 2018, 2019 for the Fed to reverse course. And friends of mine have coined the phrase the big flinch. They're giving this name to the prospective about face the Fed may have to undertake. The Fed has a very low tolerance for financial pain. And you don't know, of course, the Fed also does not want to go down in history as the second coming of the Federal Reserve, Arthur Burns and G. William Miller, those worthies being chairman of the Fed during the 1970s as the inflation got legs and kept going and going and going. So we don't know what's going on in heads of the of the Fed people, but certainly they don't want that appellation. They want some other. They want to be regarded a little bit more kindly by history.
All right, I want to keep tugging on this, and again, I want to bring inflation in too. And you just mentioned it again. I guess on this point, you, Jim, are a huge student of history. I wonder if you could answer sort of two questions here at once. One is, what sort of a ballpark magnitude of at least the initial correction you see happening here? Sounds like you're leaving the door open for the Fed to have another big flinch, but let's hold that off for a second. So not looking for a prediction per se, but just sort of a range bound. Is this going to be mild, painful, or 1929 style reckoning that the markets might be coming up against? And then secondly, what analog in history do you see, even though we're in Terra Incognita, what dynamics that you're seeing play out today look most similar like another part in history?
Yeah. The answer to so many of these questions is one doesn't know. Certainly, I don't know. I think the correction could be severe. I am a yes but guy in a gee whiz world, and I've made a name for myself by looking for risk where many others see only sunshine. But I think the intersection of rising rates, of departing liquidity. Liquidity is one of these words that it's both a stock and a flow and a frame of mind. Liquidity is kind of an elixir. It makes markets go up, but whatever it is, there's going to be less of it. And so when I think about how much the markets could pull back, I think, well, let's see. How much of the levitation of the past, the post-Bernanke levitation, is the result of actual earning power, of actual practical innovation, of the human progress, and how much of it is the whipped cream of central bank credit? And I would say, Adam, that 30 or 40 or 50% of what we've seen is nothing but the reflexive action of human beings interacting with the invitation to partake of free money. And I think that's a substantial part of the valuation spectrum. Therefore, I think that the correction could be severe. Now, you ask about analogs, about what history might teach. Well, what we know about financial history is that it helps us not in the least, because financial markets are inherently and irremediably cyclical, because that's the nature of, again, human interaction with money. We keep on stepping on the same rake. Things go to extremes. Things get very cheap, and as they get cheaper, we, oddly enough, find them less appealing. And you walk into a department store, something's on sale, you don't feel a sense of being repelled by that price. You'd rather are attracted to it. Not so in finance. So there are bear markets, there are bull markets. Bear markets, when they're severe, are absurdly severe, and similarly with bull markets. But with that truism out of the way, I think history is, in this case, what it would counsel us to do if we were prepared to listen and to interpret correctly. It would counsel us to be very humble in the face of what we can't know. For example, William McChesney Martin was the Fed chairman from 1951 to 1970, or thereabouts. And Chairman Martin was one of the great rhetorical enemies of inflation. He had nothing good to say about it. 2% inflation is a target. Heresy. He did some of his best anti-inflation fulminating in 1955, when the CPI actually registered a decline year over year. Imagine that. The world did not panic. What he said in 1955 was that, more or less quote, you never regain the purchasing power in a dollar lost to inflation. Never. That's correct. Not when you don't allow prices to decline. So, okay, that's Chairman Martin. Fast forward to 1967, to the last FOMC, Federal Open Market Committee meeting of 1967. The inflation had begun, say, in 1965, was running about 3%. And here's what Chairman Martin said resignedly, almost in a manner of surrender. In a manner of surrender, he said, quote, "The horse of inflation is out of the barn." That's a direct quote. And what's going to follow is an approximate summation. And the best we can hope to do is to make sure it doesn't gallop away too fast and too far. That was a sworn enemy of inflation. All right. So the federal funds rate then was greater than the rate of inflation. Fast forward to the present day. What we have is a Fed that is not especially opposed to inflation. Indeed, one might say that more inflation is something more to be hoped for than attained. That might say that ruefully now. But the Fed has been talking up inflation and wants more. It's wanted more of it. We need 2% plus. Indeed, when they were doing their great rethink,
they were courting it, you could say.
Right, they were courting it. They were saying, how much better it would be if we would compensate for the areas of too low inflation with something a little bit too excessive. So in their conceit, yes, in their institutional hubris, they thought they were in control of events. These people remind me of a bunch of starlings perched on a power line. They all land, and one flies off, they all fly off. So now, all of a sudden, after about not quite a year's worth of transitory, rising some more, inflation, and finally, oh God, we really got a problem. You just know what they were thinking. So now they're resolved to do something, except Adam, right there off stage, not too far off stage, is the inflation they have cultivated with a dozen years of free money. Only the point survives the exaggeration there. Dozen years of free money. And the distortions and the misdirection of capital and the perpetuation of loss-making businesses, the instigation of the creation of new loss-making businesses, all these things are going to have clogged and cluttered the economy. This is like the forest floor, right? Before a big blaze, all this junk on the floor. Well, what are these pine cones good for? and then someone say, Jay Powell drops a match, and wouldn't you know, there's where'd that come from? So I think that's about 15 minutes longer answer to a question that was very concise.
No. It was great. And actually living out here in Northern California, your last analogy there really hit home.
It's not so funny, I suppose, if you're listening.
No, it's okay. People understand. All right. Well, thank you for bringing inflation to the picture here. So here's the great conundrum that the Fed finds itself in here, right? Where the inflation horse is way out of the barn now and galloping fast, right? So they feel compelled to act. Right. And so hence the accelerated taper. And yep, we're really going to raise rates a lot this year and probably next. But then you said, there's all this dry tinder waiting to go up, in flames as all the malinvestment, gets forcibly cleared by these higher rates. And so the Fed, may be sparking a large market correction, maybe market crash. You said it could be a severe correction. So I guess my question is do you anticipate the Fed having to reverse course here, like being forced to flinch yet again because the conflagration that it ignites by raising rates is just too painful for market participants to bear?
I think so. In 2018, 2019, it took a pullback of what not quite 20%. 20%, the Wall Street Journal declares a bear market. A bear market is not a certain percentage. It's whether you actually want to go to work in the morning. That's a bear market. It's that state of being in which you don't want to confront work if you work on Wall Street. And so it took them 18 or 19% down, whatever it was in the S&P. There's all this other stuff now. All these all the oddities. If Wall Street were a museum, there'd be an oddity wing now. In it would be the NFTs and the cryptos and the venture capital, public venture capital promotions, and all these things.
Meme stocks and all that.
Meme stuff, yeah, and all the hobbyist stocks. And this is not inconsequential in dollar terms. So there's something called the private credit market, which people go to raise money for, say, a leveraged buyout, and it's done outside the banking system, outside the regulatory purview of the OCC or the Fed or the FDIC. And this is now a $1.1 trillion institution, the private capital. So always, you really find out where the excesses are after the thunderclap. What we do know is that this monetary ground has been most fertile for the cultivation of all this stuff. There's a word that I think of with respect to what's been happening in the past dozen years or so, and that word is indiscipline, or disinhibiting. And Paul Volcker, who, by the way, was just as error-prone in the early 70s and late 60s as anybody else who was trying to get a handle on what was happening. That is, he was just as human. Remarked as the process wore on, and remarked on the lack of discipline. This might have been in the 60s. That was an integral feature of that inflation. And the indiscipline is foremost, I think, in this financial inflation of ours. So if I'm right, and that underscore that word, but if we will see this this collision between the two inflations, and we will see the Fed wrestling with its own sense of dignity. I mean, imagine the indignity of having to reverse course yet again. People would begin to wonder about the clairvoyance of our monetary masters. I would like, by the way, I'd like to see the Fed once in my lifetime. So I better hurry up. I'd like to see them admit a mistake. As far as I know, I'm a pretty close student of these birds. I'm not sure I've ever heard one of them say, "Yeah, you got that wrong."
Wow. Well, you've been in the business a long time and you watch closer than anybody. So that's really saying something. All right. So thank you. And you talk about, the wing of oddities here that really might, see a lot of capital outflow. And all I'll say, Jim, is, you start losing $1 trillion here, you start losing $1 trillion there, that begins to add up to some real money here. All right, so this is an investment conference that you're speaking at here. We do have people that are trying to figure out, okay, so if we have this future of rising rates, but inflation that's going to take a while to tame, and it may include policy reversals, right, as the Fed gets serious, but then has to pull back, et cetera. Of course, the question that comes up is, well, geez, where do we try to put our capital given such a confusing place like this? And I will not put words in your mouth, but I'm going to guess you would say, hey, we got to be more nimble going forward. You got to keep an eye on where the puck's heading. You just can't set it and forget it, because there's going to be a fair amount of change. But that caveat aside, are there potential asset? You've told us the asset classes you think are going to get really kind of walloped, or at least the future doesn't look so bright for.
There are some, Adam. We have written about some things that I think are at least worth consideration. I don't sit up as an investment counselor, and no one should take these ideas as commands or.
This is not personal financial advice from Jim Grant.
You're all exhale now. But for example, there's a firm called Horizon Kinetics. Very thoughtful people. Murray Stahl heads it, and Horizon Kinetics came out with an exchange-traded fund a little more than a year ago. The ticker is INFL, as an inflation beneficiaries fund, and it's a collection of stocks of businesses that have pricing power, and that are strategically situated, in the opinion of the managers, to do well in a time of general inflation. But are also sound businesses and don't need an inflation to prosper. So during its brief time on Earth, INFL has only kept up with the S&P because they own some gold. Gold has been a dog the past year. But the energy portion of that ETF has, of course, prospered. And you knew it was going to when the keepers of the Dow Jones Industrial Average kicked out ExxonMobil a year and a half, 2 years ago, and put in Salesforce. So energy, we think, is still an interesting and perhaps repaying area to investigate. As to interest rates, there's something called PFIX, PFIX, and PFIX is and also an ETF. And what it does is to own some treasury securities and options, kind of put options, as it were, not quite, but virtually, on interest rates. And if interest rates make a substantial move upward, this will do very well. If it doesn't, you will not do very well. But it is an intelligently constructed interest rate hedge. And the progenitor of this Harley Bassman likes to say, well, it's like buying fire insurance. If your house doesn't burn down, you won't necessarily be disappointed. But people who own stocks and bonds, I think, realize full well, certainly your audience realizes full well that, again, higher interest rates do not favor financial assets. So if your portfolio comprises principally stocks and bonds, you might well investigate PFIX. There's another one called IVOL, IVOL, which is likewise an ETF that deals in that prospers when the spread between long-dated and short-dated interest rates widens. So a steepening yield curve, as we say in the trade, is what makes that go. A flattening curve makes it go backwards. So IVOL is a play on an inflationary rise in long rates, which we really have not seen. We've seen the intimations of it, but not the thing itself. So those are some possible things to investigate.
Excellent. Thank you. Those are great gems and exactly why we're doing this conference. So thank you for offering those up for folks to investigate. A closing question here as we kind of wrap up. A number of the viewers here, they track Fed policy, they track inflation, they have concerns about the continued erosion of the purchasing power of their currency. And a lot of folks like hard assets for those reasons. And you can invest in some of them through publicly traded companies. You can invest in some of them directly. Given that outlook, anything you want to share in terms of your outlook, whether you agree or disagree with that sort of general conclusion folks are coming to? And we do have a lot of folks that, for those reasons, invest in the precious metals. Do you have any sort of sense how you expect gold to do in the kind of future you're seeing?
I'm an inveterate gold bug, I am, and it's been a great disappointment so far. The kryptonite of higher rates, or the fear of same, has rather capped gold. The competition from cryptos has likewise worked against the opening of a new gold bull market. But I do retain my conviction that gold will be the survivor among alternatives to paper currencies. I'm less certain about cryptocurrencies, much less certain. But from the contrary opinion point of view, gold must be appealing because no one's interested. The gold mining stocks languish at record or near record lows as those share prices compared with the metal itself. So gold would seem to be an obvious play, but it is likewise one that has been by and large abandoned by people who are impatient for it to get going. So I'm a very big gold guy. Perhaps it's a genetic defect, but nonetheless, I have confidence.
Well, it's one you share, I think, with a lot of people watching this video. We'll wrap up here, but I got to ask this question just based on what you just said. Again, you have you are one of the greatest scholars, I know, both of interest rate policy, monetary history, all that type of stuff. You've said you've been a fan of gold for a long time.
I invented it, actually.
Pardon me?
I invented gold, actually.
Yes. Well, thank you very much. Very much appreciate your work there. But given the scope of your career in terms of being a gold investor, how do you see gold's prospects going forward, given everything we talked about, versus other times in your investing career? Is this one of the better times to own gold, medium, the best ever? What's your perspective?
I think it's a terrific time. You don't have much company. Gold has put in millennia of service as a monetary medium, and I think it does not share the impatience of its 21st century fans. So gold is eternal, and our attention spans are demonstrably finite. So I don't know. I think one owns it, doesn't look every day, and waits for what I deem, this is a dangerous word, but waits for the inevitable. The inevitable being the tendency of paper currencies or digital currencies, in any case, government issued currencies to lose value. The tendency of credit structures, leverage credit structures, to weaken and sometimes to crash, and the inevitable tendency of people to look for, in those instances, of people to search out stores of value that have proven themselves over time. I think all of those tendencies are coming together, and I think we're set up for a new, substantial new bull market in gold. Now, I've held this opinion for a while, and I'm the world's leading authority on when it's not going to begin. You asked my opinion, Adam, and there it is.
All right. Well, Jim, thank you so much. It pains me to have to cut this interview short because there's a whole list of other questions I'd love to get in with you. Hopefully we can have you back on our regular Wealthion program at some point again soon. But thank you so much. And for folks that would like to follow you and your work, where should they go?
The great World Wide Web, we're easy to find. We welcome them on our website.
All right. And that's grantsinterestratesobserver.com?
Yeah, Grants Interest Rate Observer. Yeah, there we are.
All right. Thanks so much, Jim. It's been a pleasure.
Thank you, Adam.